Hey, third day of Technical Analysis Wednesdays today, sixth day overall. Looking pretty good. We're getting into it, guys. We're looking at our complex trading setups today. Really cool stuff. We're building on the stuff we know, support resistance, trend lines, and we're putting those into setup patterns so we can use in real time and make some really cool trades on. Make some money, get it going. It's the strat. A lot of people use them. It works really well. They're good patterns, minimize risk, and it's really great predictions for future market patterns. Looking at how we can apply it to the rest of the market and get ourselves some lead gains in, guys. Draw on those charts and enjoy. Cool. We'll get started then, and whoever comes in, that'll be fine. So, intro to complex chart patterns today. This is the active trading stuff. Yesterday, we were talking about slow stuff, long-term market index funds, the more stable, less skill, more just put your money in, you'll be fine. Today, we're talking about the quick trading, the skill trading, the short-term active trading, and then sometimes we'll see these in longer setups too. So we're going to set up a daily chart, and we're going to start to look, well, I guess we can start a little bit medium term. Let's do February 1st to February 25th, 2018, and we'll just do good old make-believe pharmaceutical corporation. Alright, so we've got our stock, MVPC today. Wonder if that's a real stock. I don't think it is. So we're going to look at wedges and triangles first. So we saw support and resistance last Wednesday, and we saw how we can game on that. What we're going to look at first today is setting up triangles and wedge patterns with that. So the first thing we're going to look at is a downward wedge. So in a downward wedge, I'm going to erase the ticker, the stock, the price, it doesn't matter. What we see with this is a downtrend in the price, and it's going off of a support into a resistance, and we can see with the tops that the resistance is continually going down, but the support has a solid bottom, the support's staying. And we can see this in medium term, we can see this sometimes long term, but this is mostly medium and short term. So with a downward wedge, we can usually expect a stock once it gets to where these two lines cross the support and the resistance. We're going to see downward price movement most of the time. Now, I wish I'd do that a little bit smaller, but it didn't. The opposite is true with a upward wedge. So if we have the one we just drew, and we'll go down, and we have a resistance here and a support, and the support's going up, and we see a channeling pattern, and we can see the resistance here, the support here. Usually when it's going up, we're going to see upward price movement. So downward price movement, upward price movement. Sometimes with these setups, these are usually very solid. Like upward wedges and downward wedges are usually very solid indicators, and they are very good predictors. Sometimes we might see something where we'll have an upward wedge and it goes up to a level, but then maybe it was a false breakout, and it goes down. Maybe it goes down to right about here. Usually when we see reversal off these movements, we can really stick with that reversal call, and it's probably going to keep going down if it couldn't break wherever this was, and it went down off of an upward setup. But most of the time with these upward setups, we're going to see them continue to trail up and make new highs. Now the price target for these new highs is going to be pretty much the bottom alley of this support and where the resistance is. Whatever that distance is, bring it up. That's going to be your sell target, or at least the price where you're going to start to have some more resistance off of it. So from here, we do the same thing. These are the same distance, and that's where your sell target. That's where you're going to need to watch out for resistances if the position goes up, and if it goes down. If you have an upward wedge and it goes down off a false breakout, you can usually the price will usually follow the downward movement, and it probably won't recover very quickly. It can definitely recover, but there'll be an immediate downward movement. And that's the same thing with these downward wedges. If we see the price going down and maybe we short it, our price target to cover will be from the bottom of the support to where we can see the price start going into this downward flag or wedge. Take this. This is where we're going to start to see some resistance. It's the same distance here to here. And that might be our buyback target if we short it, or maybe a place where we might keep holding it, maybe sell half of our position or something. But be careful, because that might be a big resistance. Maybe it'll bounce back up and go up, and if we have a short position, we don't want that. Same thing with these downward wedges though. If it looks like it's going to go down, we see this big downward wedge, but then we get this bounce and it starts to go up. Usually, if it's a false breakout and it continues going up and it does the opposite, it's like a false pattern, we're going to see it follow the upward price movement. So even though it's a downward wedge, if the market says it's going to go up, then it's going to go up, because people are going to pay more for it, it's going up. So these are easier to read most of the time. The downward wedge, you're going to see lower prices, upward wedge up, higher prices. Something to watch out for are equilateral triangles. So we'll have a stock trending, and maybe it starts at the top, maybe it starts at the bottom, but we see a support here and a resistance here going into a certain point, and you can't really, it's not up, it's not down. With these, you got to be a little more careful, and usually the strat is to just wait for it to come past here and see if it goes up, and if it goes up, you'll usually see upward movement. If it goes down, you'll usually see downward movement. False breakouts, reversals don't happen all the time on the oriented wedges. So with this equal wedge, it's even less there's less reversals. If it starts to go down, it's not particularly likely it's going to go up. Of course, you always want to set your stop losses. So maybe a 10% stop on this. If you're going long, you would have it here. So if it does go up and then just do a completely weird reversal, you'll be able to stop out of that trade and lose your eraser that's right in front of you. All right, so next big pattern is head and shoulders. Now this pattern, you're not going to see it every single trade, but huge pattern, like if you see it happen, you're going to be able to make a really good trade on it, because it's a very, very, here, let me draw that better. It's a pretty consistent pattern. Like if you see it, you can pretty much assume that your head and shoulder pattern is going to go through. So in a head and shoulder pattern, just pretend I didn't go too far this way. You're going to see, maybe this goes a little higher. First thing you'll notice is that there's going to be a big support right here. You see it bounce here, you see it bounce here, and it starts here and it ends here. And we're also going to see a resistance here. So the two shoulders meet at the same point, but the head and shoulders, the head's higher and the head's above that by a good amount. That's like probably here to here, here to here. With a head and shoulders setup like this, we're pretty much, usually we're going to see an upward price movement off of this, and we're going to start to see the stock trend upward. I don't want to erase this stuff, but I mean it's going, usually it'll trend upward after a head and shoulder setup like that. Now there's also the inverse head and shoulders, so the upside down. So if we have this same line and we have a stock trending and it does, oh, did I do it wrong? I think I did it wrong, my bad. So with the normal head and shoulders, it's actually gonna go down, my bad. Yeah, so you'll see a downward movement off of a head and shoulder setup, because it's not holding this for support, it's not holding this support, these aren't turning, or it's not holding, not holding the support, it can't stay above it, it's too much of a resistance. So with the normal head and shoulders, it's gonna go down off of this movement. And with the inverted one, we're gonna see just the opposite. So the whole thing's set up, but it's upside down. So it goes down right here, and we're gonna see it go up off of that, because it's breaking through this. It's been trending on it, and now it's breaking through. So head and shoulders, you're not going to see it a lot, but when you do see it, it's a pretty safe, it's a good trade. Normal head and shoulders, you're going to see a downward price movement most of the time, and inverted upside down, you're going to see the same thing as this, but it's upside down and upward price movement usually. Really good indicators. They're very, strong. If you see a setup, a head and shoulders setup, it's usually a pretty good setup. One of the better ones. You're not going to see them all the time, but very good when you see them. Next big thing to talk about is going to be hammer setups. So these are specifically short-term trading only. With the hammer setup, what we're going to look at are like the 5-minute or the 1-minute candlesticks. And I'm not the best candlestick drawer, but I will try my best. So these are going to be red downtrending candlesticks. Okay. So the candlesticks trend down, and we're going to start to maybe meet, say there's a support here. And with a upward hammer, we're going to see a candle set up, it goes like this, and then we're going to see this. So this is a hammer because it opened, this is a green candle. So opens here, goes up to here, which is a pretty big drop, but then it goes up a lot, and then we close here, which is above it. Now the thing that's important about the hammer setup is there is no candle wick coming out of the bottom of it. So it's just the upper one and then this box. Sometimes it can be red, usually it's green in this setup, and once we see that, we're usually going to start to see the price trending up. So we'll have, the next candle goes up, and it's a pretty good reversal sign. Like if you don't have a downward wick, you're going to see usually a really good reversal off that. And it's the same thing if I draw it a little smaller. If we have some green candlesticks going up, and we're going up, price goes up, and we see at the top a red one of these, and the tail goes down, no wick on the top, just set up like that. We see it opens here, and then it sells off all the way down to here, which has been a pretty consistently held price level. We're gonna see no wick up here because it doesn't make any gains. It just sells off and then it recovers a little bit. And usually with the uptrend, that hammer setup is going to be a good indicator of lower prices following it. These are really good setups for short term, and you can actively trade these. You short here, you buy here, set your stop losses, You can't really draw that far up, but set your stop losses. And those can usually be some pretty good setups. Alright. Got that. Makes sense, yeah, probably. Cool. Any questions? No? Alright. Let's redraw axis. So,
He wants to know when we're leaving.
huh?
He wants to know when we're leaving.
Oh, probably like 3:20.
Oh, I'm leaving at like 5:30.
Wait, really?
Yeah.
Huh.
I'm staying for Mr. Brown's tutoring.
Oh,
Till
you got
5:30?
Yeah. It starts at 4:20.
What?
Those are like the biggest setups. Head and shoulders huge. You see that downward price move, and that's big. But a lot of trading really is playing off the support and resistance levels we talked about last week and looking at those. Big one is the ABCD setup. So,
Okay.
what's up?
I have a question.
Yeah.
So there's a head and shoulders pattern.
Yeah.
Is there a knees and toes pattern?
Not that I know of.
Dang.
So this is called an ABCD setup. So why it's called that, we've got this A, and then we've got this big B, and then we've got a C, and the D is what people trade. Everyone wants that D. So let's just erase the huge ABCDs and look at what the real thing with this is. And this is a great one, especially for opening market. Like if you have a stock that's gaining up in the morning, so maybe this is the aftermarket, and yesterday it was, you know, down here, and it gapped up in the morning. A lot of the times you can see this pattern, and it's very good to trade. If you don't get in on the opening bell when it has this initial spike up, run up, what you're looking for, you don't know this, right? So you have this big run up in the morning, or, you know, this is probably one of the few that can be applied to longer term too. This can be long term or medium term and short term. So we'll see this big run up, and people, you know, they hit a resistance here, and usually no one really knows where this resistance is. It's coming out of nowhere. It's just a psychological point. And then we'll see a downtrend. But the difference between this and other downtrends is if the downtrend, you know, keeps going and scrambles off, you got no pattern. You can't really, it's tough to trade that. You could make a short up there, but it's sometimes even tough to call, at least without any, you know, history behind it. But with the ABCD pattern, what we can see is a short retrace, but then it starts to kind of hit like people are trying to buy it back here. And it slowly, you know, it might go sideways for a little bit, and that's good, and that's keeping the price at a level where new people are going to come in, new people are going to see this spike and get in on it. And we start to see a slight little curve up, and once you see this, this is the more aggressive entry point. I usually would take this entry point, but the more conservative entry point is when it hits this high again. When you break the new high a day, that's when you really start to see big price increases, and it's you know, it's pretty much always either it breaks the high a day and goes really high, and this is with anything, not just the ABCD pattern. So if you have any stock and it's approaching the high a day, this is a really big point for it, because it can either fail to break the high a day and we can have a double top resistance, or it can break the high a day and we're going to have a lot of support behind it. We're going to have a lot of people trying to move in money and a lot more volume. And that can be really good for price increases, and that's the D in A, B, C, D. So if you want to be a good stock trader, all you gotta do is learn your ABCDs. It's easy. Anyway, this big price increase, usually your sell target for this is somewhere around the bouts of here to here, take that, and somewhere up here. I drew too high, but it's okay. You get the point. It's from the start of the run up to the height it gets to, on top of the maximum it gets to. Yeah, ABCD pattern is really good. Another thing with retesting the highs, high day scanners and gappers who go off of the high day are the ones that we're gonna see on like circuit breakers. So they're gonna be kind of the high flyer stocks for the day. So if we can get a stock and maybe get rid of this timeline because it's not the best. If we say this is the daily chart and this is 9:30 and this is like 3 o'clock in the afternoon, and we see this big run up in the morning, we're gonna get a lot of attention on a lot of media coverage. And even without patterns, you know, if you see it maybe drop down here and it's, you know, noon, and people are starting to flow away from it, but then towards the closing bell, 3 o'clock, you start to see more volume go up into it, and you see something like this, where you're really testing that resistance line, but since it's such a short period of time, you have a lot more people behind, a lot more volume behind it, and what happens is if you can break this previous high, you're going to set up for some really good prices. And you can tell your buy targets from here by looking at the history of the stock and looking at the support and resistance from the history of the stock, and you'll draw your lines across. So maybe this, you know, I see a line somewhere around $9. In the history, it was spiking along a lot, and $9 was always a pretty big support resistance. I might set my sell target at $9 because I know it's going to be tough to break $9. I might sell like half my position, see if it spikes up, and if it goes down to like 8, you know, I'll sell the rest of the position. or you can keep it and see, maybe it's going to go up by the end of the day. At that point, you're really not relying on technical analysis. It's just feeling out the markets and a little bit of luck. But that's the point of what technical analysis is for. It's to increase your luck, or not your luck, but your chances of being correct. Like even much better, especially with that ABCD setup. We see right about here. Our downside, if we set our stop loss, stop loss probably right about here, and our upside is probably this to here. So the upside goes, up to there. The upside's double the downside. So 2 to 1, or risk reward. You got double the reward. So if you just take that trade, 100 times, you're gonna end up good. You're gonna end up very well because, if it goes and it keeps going up, you're gonna sell high, or you'll get stopped out if it's a false breakout. Makes sense? Yeah? Any question? No? It's fun. Those are the biggest setups. There's tons and tons of setups online. Those are the ones I find myself using the most. Some of them are just kind of weird and hard to remember, and that's the thing with these setups is committing them to memory is huge because, well, at least in the short term, if this is a daily trade and you need to make these trades, like, especially in the morning, you need to decide how well the trade's doing in like 5 minutes or 15 minutes. Like, you need to have these down so you can do them really quick, and you can look at it, within the second sometimes, and you're thinking, oh, this is a setup for something, and I can trade this. It's less important knowing it really quickly for like the medium to long term. If you see like a big head and shoulder in the medium term, and it's like a 3-month chart or something, then it's just more recognizing it. But when you get to that short term, really active, quick trading, that's when these patterns start to come up a lot more, especially with those high day patterns. If you're trading gaming stock, and you're going to need to know them quick, and you're going to be able to trade them quickly. And that's how you're going to be able to set your stops quick, get your price targets in, and make your good profits. What's up?
Then you cut to the chase and give us the stocks so you have to start making money.
Yeah. Can use these with any stock, man. Just like, look at companies you like or use, stuff like that.
I need the ones you use smartest.
Huh?
I said I need the ones you use, you're the smartest.
Dude, a lot of the times with technical analysis, I've had a ticker up here the whole time because obviously I'm just drawing everything. But, if like you see the charts and you see the setup for something, like what's a company you hate?
Chick-fil-A.
Chick-fil-A. Let's pretend Chick-fil-A has stock, okay? And they're trading under CFA. They're private, but we'll just, You hate Chick-fil-A?
I love Chick-fil-A.
I like the food, I hate the values.
Alright, let's say Aaron hates Chick-fil-A, but he goes to Chick-fil-A and he sees this on the 12-month chart. So this is 2017 to 2018. Why the heck not? He sees we've got shoulder, and this is where you can really start to identify head and shoulders. But it's sort of tough because at this point in it, you see this support, you see the support, and it's kind of like, maybe it's going down, maybe it's not. It's sort of tough to time the top, the heads of the head and shoulders, because you don't really know it's a head and shoulder until you start to see the formation of the second shoulder, and then you can really start to trade it and see, oh, okay, it's probably going to go down to here, so maybe you short it down to here, but that's still a tough trade to make. But when the real profit comes in, no matter what the company is, you don't care about the company, you just look at this chart and you say, this is, an inverted head and shoulders, we're going to see upward price movement on this. You get in the trade, and you can sell out the company, here to here, here to here, sell out. If Chick-fil-A was, $10 stock, maybe at 15. And, it doesn't matter what the company is. You're making your gains, and you pay the same amount of taxes as the amount of the company, so doesn't really, the company is not important with technical analysis, stuff like this, especially when you get into really short-term penny stocks. Like, I mean, the pre-market gainers and all these guys that are high flyers for the day, I mean, 90% of them, I have absolutely no idea. Like, there are a lot of pharmaceutical companies, there are a lot of little cheap, like, dollar stocks to, you know, maybe $15 stocks. And you're not gonna have heard of these ever. And the company doesn't really matter. With the charts, with technical analysis, with short-term, medium-term, just trading to get in, trading to get out, you're trying to, you know, game it off of the charts. The company isn't as important as your technical analysis of what they're doing, what their charts are doing, and how they're moving. That makes sense? Yeah? Cool. Alright, that's pretty much everything I had to get through. Those are the biggest patterns, especially with ABCD. I mean, you see those on some crazy stuff. I know Bitcoin pulled one of those, and it was terrific setup because you saw, like, and it was so long term too, because we saw, I think it was like 2011, 2012, we saw this big run up in the price, and then we saw this huge C. And then there was the big, everyone knows what happens there. Hopefully. I mean, it went pretty quick, and it did it pretty well. I mean, we saw some staggering here, and then it was a little slower, but in the long term, you know, it's still insanely fast growth. And it might not be straight up, well, at least relatively, it was pretty straight up by a lot of term. But, you know, the setup, it was a setup. That was an ABCD setup. So when you see the setup, you know, who cares what it is? You can take the trade on it. All right. Cool. Make sure when you're looking at the hammer patterns, you're looking at like 1 minute or 5 minute charts. And a lot of times we can combine hammer patterns, wedges, support resistance alleyways like we talked about last Wednesday, with or even like these big spike ups. Actually, especially with these big spike ups in the morning where you don't really know what they're doing. We're going to talk a lot more about indicators next Wednesday. But, you know, maybe you have a stochastic, so VWAP. We'll talk about that next week. But those indicators can also help you in the short term, looking at where, you know, where you might see a big breakdown. If it hits it, you know, we'll talk about VWAP, volume weighted average, next week. But big important stuff for short-term trading isn't really the indicators. A lot of times you can just look at it, draw your lines, you know, recognize your patterns, support resistance, put it on there, and you can make good trades just trading off the charts. Got like 2 minutes left. I think we did pretty well today. Go team.
Great.
Yeah, trade the charts, make some money. I mean, this is not like market return money. This is active. You're doing this actively. You can make a lot more money than just, you know, your 7% market return by managing it actively instead of passively. Because we talk about passive stuff a lot. This is active management. This is like commitment. You're in this and you're working for this. So you're gonna see a lot more gains than just, you know, your S&P, your index fund, your market averages, your market movers. Cool stuff, guys. I'll see you next Tuesday.